come on up and take your seats. And Victoria Guida is going to lead our conversation. Many of you know Victoria because you see her in your inbox when you read Morning Money in the morning. You see her bylines and quotes. You see her presence on Twitter. I was recently talking with one leading policy expert in financial services who called her simply the best reporter he's seen out there in the world today in financial regulation. So it's our great privilege to welcome you to the Brookings stage, and I'll let you introduce the great panelists. Thank you for joining us.
Thank you so much for that kind introduction. Thank you, and thanks to Brookings for hosting this event. I have three people here with me who have more than enough direct experience to dig into the issues raised by Director Gruenberg. I'm going to give very abridged versions of their resumes because I'm sure most of you are familiar with their work. Next to me is Sir Paul Tucker, who was Deputy Governor of the Bank of England from 2009 to 2013, and now he chairs the Systemic Risk Council. Next we have Jim Wigand, who experienced the FDIC bank resolution process up close and personal as head of the FDIC's Office of Complex Financial Institutions. And last but not least, we have Kieran Fallon, who is Senior Deputy General Counsel at PNC, and he spent many years as Associate General Counsel at the Fed. So I'm going to take up most of the time here, but I'm going to reserve some time for questions at the end. So I want to start with last week. The Fed moved to ease some regulations on a lot of the institutions that we're talking about, banks bigger than $100 billion in assets, but not designated as important to the global financial system. So where I wanted to start is, Paul, I know the Systemic Risk Council has raised some concerns about what that proposal might mean. So my question is, do you think that this will affect the likelihood of some of these institutions failing?
It will. So I think the Fed has made a mistake. What they've done is they've reduced equity requirements for some banks, reduced liquidity requirements for some banks. But then, as Marty Gruenberg said, they have relaxed resolution planning requirements for a number of regional banks and have abolished resolution requirements for banking groups with total assets of between 100 billion and 250 billion. You frame the question, Victoria, in terms of does this increase the likelihood of failure? But I want to answer it in terms of yes, a bit, but also has it affected the capacity of the authorities to cope with failure when it occurs? And that is the single, in this area, that is the single most important question. I think that completely abolishing resolution planning for banking groups between 100 billion and 250 billion is a decision that no reasonable regulator could reach. And for those of you that are lawyers, I'm using a test in English administrative law, and that's a gentler test than the hard look test that is applied here. I think the FDIC has it in its power to remedy this if, rather than following the same course for the resolution of insured depository institutions, if it changes course, and actually, as Director Gruenberg aired the possibility of this, the SRC has positively proposed this, actually requires regional banks to issue bonds, so that after the equity is exhausted, the losses need to go somewhere. That's the approach taken in Europe. This business of requiring so-called bail-in bonds to be issued only by GSIBs, that's a US thing, and it's a US thing that flows from the fact that Dodd-Frank had to be passed by the fall of 2010, and that was only 2 years after the nadir of the crisis, and thinking hadn't developed far by then. So yes, I think a big mistake has been made, a mistake that no reasonable regulator could take in one part of it, that's quite a big thing. That's quite a criticism. I want to make that absolutely clear. But I think this can be remedied and should be remedied, and I hope will be remedied by the FDIC. And the only other thing I'd say is that one of the things that surprises me, a bit on both sides of the Atlantic, but certainly here, is that office holders don't have the sense of fear which certainly gripped their predecessors only a few years ago. And I'm genuinely surprised by that. That sense of, oh my God, has passed so very quickly, and this is not in the interest of the American people.
Yeah.
So we'll just go down the line here. I echo Paul's comments that the probability of failure has increased, and that's because capital ultimately is the cushion that absorbs any potential loss that one of the financial institutions will take as a result of either a macroeconomic event or just the fault of the institution's management and idiosyncratic characteristics of its own portfolio. Capital is what absorbs loss, and any decrease in that will increase the probability of failure. However, that has to be balanced against the fundamental economics of the capital structure and the marketplace associated with the risk profile of the institution. So, ultimately, this is and has been debated for years, if not decades, as to how to balance those two factors. And the way you frame the question, Victoria, is that yes, the probability will increase, but the question is, how is that balanced against the risk? Well, there are other components. Liquidity is certainly one which Marty alluded to in his comments, that the runway to a failure is increased time-wise if an institution has sufficient liquidity to keep its operations going. And if that time frame is compressed, that runway is compressed, then to Paul's comment about the regulator's capacity to deal with the problem becomes more difficult. So liquidity in the resolution context doesn't necessarily change the probability of failure, but it does influence it. But really, it has a more material impact on how failure comes about, or how it facilitates the ability of regulators or other persons to deal with the failure. And so that is an important component of liquidity. And then with respect to resolution planning, it's a little surprising that an aspect of human behavior has kind of not been discussed or really brought to fore about this. And that is, with respect to the process itself, the planning process itself, at the institutions who put together the plans, a really high degree of resources have been dedicated over the past 7 years in that effort. And the people who work on those plans at the institutions took the exercise very seriously and had great cooperation ultimately by others within the organization to put together a very strong planning process and a robust product that the regulators in turn would review. As you extend basically when those due dates come about, the natural tendency will be to remove resources, and the people who work on that will be directed to other work streams, and the organization itself will, just by its very nature of not having to focus on it, not focus on it. And ultimately the question is, how much has that process been baked into business as usual processes elsewhere, outside of the resolution planning stream, such that resolution is taken into account as any type of changes in the structure or market footprint, operations, acquisition plans, cross-jurisdictional activity. The list is endless, but ultimately is how much has that been baked into the process so that, in fact, the institution is going to be able to actually have a resolution, a capability to deal with the resolution, or the regulators have the capability to deal with the resolution in the event it actually were to fail. And so that is kind of really something that's been missed. The time frame, people think, oh, the product just becomes stale. Well, it's actually a larger issue than the product becoming stale.
Right, yeah, and Karen, I want to bring you in on this too, and I'm also curious your response to, Director Gruenberg's proposal, and Paul brought it up here too, about this idea of requiring bail-inable debt for more than just the mega banks, this TLAC proposal. So, your response to some of the points they brought up,
Sure.
and what do you think about that idea?
Sure. So I think I think theoretically you have to agree to the extent capital levels are reduced, it does increase the probability of default. But I think it's a matter of degree. I think the proposals that were recently finalized by the agencies don't really gut what were the core capital liquidity requirements that were enacted after Dodd-Frank. I mean, I think, all would admit, including my organization, that capital and liquidity levels were far too low before the crisis. They've been substantially increased after the crisis, and I think these recent rulemakings, fine-tune those requirements to some extent. If you take a look at at least the Federal Reserve's estimates on this, their estimates were that the capital changes that were recently adopted would alter capital only about 60 basis points in terms of risk-weighted assets. And in terms of high-quality liquid assets, the liquidity requirements, the changes would only reduce those requirements by about 2%. For institutions that have more than $100 billion in assets, those organizations would also still continue to be subject to the Federal Reserve's Section 165 liquidity stress test requirements. So for many organizations, those requirements are themselves your binding liquidity restraints. So for those organizations, these modifications really wouldn't alter the amount of high-quality liquid assets they retain in order to make sure that they have adequate liquidity in terms of a crisis. With respect to resolution planning is important. And as Jim said, organizations subject to those rules after Dodd-Frank and those institutions, IndyMac and WAMU and Nat City, who we acquired in the crisis, weren't required to have resolution plans. That was a very fundamental change that was put in place by Dodd-Frank. Our organization, I can't speak for everyone, but I assume, have invested substantial resources in that. We've gone through several iterations of our resolution plan with feedback from the Fed and the FDIC as appropriate. They had largely reached steady state. That's not to say that there wouldn't be material changes in our organization going forward, or at some point the credit cycle is going to turn. I agree with what Marty said. When things look really good are the times that you should be concerned. Credit cycles come and go, and woe are the bankers that always think housing prices go up and your corporate customers are not gonna fail. We've seen this show before. We'll see it again. Resolution plans are really important. I do think the agencies still have the flexibility to request a resolution plan in case the circumstances change. So that 3 and 6 year time frame that are generally within the rule for filing, at least for a triennial filer like PNC, a full and targeted plan aren't hardwired in the sense that they can't be changed. The agencies can change that timing if it's appropriate, if economic circumstances change. And institutions actually have an obligation to update their plans if they do undergo a material merger, acquisition, or something else that would fundamentally change your resolution strategy. So all in all, I think, is the balance there right? You'll have to see how things play out. I mean, if indeed situations get worse and the regulators don't exercise their authority, perhaps for particular institutions, to accelerate those resolution plans, then I think, I would agree that would be a concern, but it's too early to say that yet.
I kind of want to ask a more provocative question. I mean, given what we were just hearing about Washington Mutual and basically how the stars aligned when it came to dealing with the failure of that institution, I think I'm going to pick on Jim for this one. Are any large regional banks too big to fail?
It's a very good question, and I think the answer is one of looking at the context of failure, circumstances of failure. There was even a debate when Washington Mutual failed as to whether or not its failure would be systemic. And the systemic element of that was not the fact that uninsured depositors might be taking a haircut. We looked at that issue and were concerned about such a large number. So that was kind of a clear case. If uninsured depositors took a haircut, there would be a contagion effect in the midst of a financial panic associated with that, because others would look at their financial institutions and say, I'm not going to take a risk, I'm going to withdraw my money. You would have runs, and ultimately that's what caused Washington Mutual to fail, was a run on its deposits. That's what, well, that was the immediate precipitating event. Obviously it had capital issues, fundamentally. But any large regional bank, if it were a standalone failure and in the midst of a very healthy economy and a very stable financial system, depending on its degree of integration with the rest of the financial system and cross-jurisdictional issues. See, already I'm starting to build in some hedges here. Might be able to fail without being called too big to fail. But if you're in the midst of a financial panic and it appears that uninsured depositors would have to take haircuts, and bondholders might have unexpected losses, and the key word there is unexpected, because I think with the TLAC requirements associated with the GSIBs, there is now an expectation that that will be a loss-bearing debt class, but I'm not sure to the extent that type of thinking has filtered down into the tiers underneath the GSIB level. That there might be cause of concern about what a destabilizing effect the failure might have on the financial system. So yeah, it's a difficult question to ask, but it is very, very concerning that they certainly could, put it that way.
Seems like Paul has some thoughts.
So my answer to your question is there is absolutely no need for these institutions to be too big to fail. But if the Fed and the FDIC remain where they are, they could end up being too big to fail. So the answer to you asked earlier, what could go wrong if one of these things? So this bridge bank thing, it's a euphemism. It's temporary nationalization while the FDIC, or in my country, the Bank of England, looks for a plan. And then the question is, when someone doesn't buy it from you, where do you put the losses? After equity, after bonds? Do you put the losses on uninsured depositors? If you do, the grave risk would be that the uninsured depositors of other regional banks would say, you mentioned no interconnections. You don't have to have direct interconnections. You just have to have similarity of structure. I'm an uninsured depositor of this regional bank. I've just had my deposit haircut as to 50% or whatever. That's going to be in the newspapers. People will take their uninsured deposits out of other regional banks. And so you would get contagion through the regional bank world. And in those circumstances, people that were elected policymakers, they would suddenly start thinking about how to rescue these institutions with taxpayers' money. This is unnecessary, so they could end up being too big or too politically toxic to allow it to fail. That's unnecessary if ahead of those uninsured depositors, there are some bondholders who can be whacked, but as Jim said, that would need to be understood. The other thing that could happen is, say that I believe, and say that actually God's told me this is true, that actually the FDIC is magnificent at resolving small community banks, which it absolutely is, but also that it has credible plans for Goldman Sachs and JP Morgan, and in my country, Barclays and HSBC, and say that's true, but that actually a medium-sized regional bank comes along and fails, and it's a complete mess, and the FDIC and Fed are revealed as not having a plan. No one out there, no one normal, is going to believe in the credibility of the resolution plans for JP Morgan and Goldman Sachs. Even if that perception, even if that inference is false, it will be the inference that people that would draw. This is why I say it's a terrible mistake. If you don't have a plan, don't quit planning. And they have not, at the moment, got a credible plan. And I would not say that unless I had given the matter a great deal of thought and truly believed it. And I may be wrong, and actually I hope to God I am wrong, but at the moment I do not believe they have a plan, and so I can't for the life of me understand why they've quitted planning. And actually, the FDIC hasn't quite got that far for IDIs, and I hope it won't.
Well, just to clarify, who doesn't have a plan? Because we have a plan. We've been required to have a resolution plan, which has been reviewed by the Fed and the FDIC and determined to be credible. So,
and how would you be resolved? Describe the plan to me.
There's a public section of the plan and there's a confidential section of the plan.
It's P&A.
But
It's P&A.
No,
it isn't bail-in.
I do agree with Marty that for a large regional bank, a bridge bank option, which is permissible under the FDI Act, would probably be a more likely resolution scenario for certainly for a large regional than it would be for a community bank. And I certainly agree that there are challenges that would be presented by any large regional bank failure. That is, beyond dispute. I mean, it is PNC's $400 billion in assets. We're far from the GSIB territory, but let's face it, that's a lot of assets. We're a large bank. Do we think we've presented credible options for the Fed and the FDIC? And I'll say mostly for the FDIC, because within our organization, 97% of it is in the insured depository institution, our bank. That actually reduces the complexity of our organization. It reduces the amount we have to, rely upon market funding. We're primarily deposit funded within the institution. We've presented different ways where we think the FDIC could resolve us through a bridge bank. I agree that the opportunities for a single acquirer to make an acquisition is reduced the larger the size the institution gets. And you'd be faced with decisions that you wouldn't want to be faced with in terms of, particularly if it was a U.S. institution that was going to be making that acquisition. Do you want the large to get larger? There might be a possibility for a foreign institution to come in that doesn't have much of a U.S. presence, but the range of options does get narrower.
Yeah,
so institutions like ours, we come up with different strategies that can be used to break the institution up through smaller transactions, through partial sales to different bidders in order to maximize the value of the organization so the FDIC can meet its least cost test requirement while still resolving the institution in an orderly way. Is it perfect? Probably not. Has it been tested? No. Thank goodness. I do think, when I was at the Fed and Marty was at the FDIC and you were as well, the agencies ran simulations about how you would run a resolution. I would strongly support the continuation of that, and to the extent the industry can help the FDIC, improve and understand how to make one of these resolutions work. I think we're all in favor of that.
So I was going to just sort of add on to some comments that both Paul and Kieran have been making here, and actually Marty alluded to it too. I mean, FDIC got really lucky with Washington Mutual because of the fact that one, the regulators were willing to allow large institutions to get larger, even though there was a certain it wasn't something that was a desire, but they were willing to do it given the facts of what were occurring back in the fall of 2008. But, and we haven't spoken about this, the market was willing to make that acquisition, that there were acquirers who were willing to do it. Given the litigation and the contingent liabilities associated with the acquisitions that took place during the financial crisis, and you start with Bear Stearns, and the acquisition JP Morgan made of Bear Stearns, which wasn't a depository institution, but nonetheless it put on its balance sheet a significant amount of contingent liability risk associated with the mortgages and the operations of what Bear Stearns had. I think there's going to be, unless memories of these boards are very short, there'll be a great reluctance to be willing to make that type of acquisition in the future without a significant indemnification from the government. And that would then require a high degree of political tolerance in order to deal with the value of providing that indemnification. And I'm not even going to speculate as to whether or not that would be possible. So a P&A is, from both the regulatory perspective and probably from the market perspective, not really an option. So that takes us to the bridge bank option. And when we think of bridge bank, we should think of that in the terms of operational feasibility. And there are a whole host of issues. I mean, Kieran and Associates, I alluded to them. Marty's alluded to them. There are many operational issues associated with a bridge bank. But you could struggle through them. You might be able to operate a bridge bank without significant knock-on or contagion effects. But the capital structure ultimately is going to dictate whether or not the market is going to have a severe reaction. Because ultimately, where the losses go and who bears those losses will define how the market reacts. And the expectation versus reality is a component of that. So if there's an expectation that you're going to bear a loss, then the market reaction is significantly less than if you were not expecting a loss and all of a sudden out of the blue, you say, geez, look at this. My uninsured deposit, I received a 50% haircut, and it might be because the characteristics, the profile of that particular bank that failed was such that there's no way you could torture the least cost test to make it work to basically convey the uninsured deposits in a transaction. So yeah, the capital structure is a very key component of this. And I do think what saved the FDIC and, quite frankly, uninsured depositors from running at particularly the large mid-sized banks and even the larger banks to some extent was the fact that no uninsured depositor suffered a loss when Washington Mutual was resolved. And that was only feasible because of that $13.8 billion of loss-absorbing debt that buffered basically the equity loss and the deposit class of creditors.
Yeah, so jumping off this idea of whether or not there's a bigger fish, right, and whether there's a bigger bank that can take over the failed institution. One thing I'm sort of curious about is obviously one of the major trends in the banking industry is mergers and acquisitions, and the number of banks is shrinking, and so you're ending up with a smaller number of institutions that are getting progressively larger. And one of the effects of the recent regulatory moves could be to allow some of the larger regionals to get a little bigger. And so I'm curious whether this just makes all of the problems that we're talking about even more complicated. To have banks, for example, the proposed merger between BB&T and SunTrust, that will wind up being one of the biggest banks in the country. So is this a trend that's good to have maybe like a smaller number of institutions to focus on, or does that just make everything even worse?
I'll head off. I think, I think the combination of SunTrust and BB&T is driven by a couple factors. One is the need for scale for technology and cyber these days. I think if you actually look at what SunTrust and BB&T indicated is, the market is developing. Consumers want digital products. They expect everything to be on your cell phone. They don't want to go to the branches anymore. That takes a lot of investments. That requires some scale. So I think that is, a main driver behind that. I do think, I'm not saying you want to see, those regionals become GSIBs, which would then, create additional problems. But if you look at the deposit deposit gathering over the last several years. The largest banks, the largest and most complex banks, have been growing deposits at a rate of about 20% between 2013 and 2017. Smaller banks have been growing deposits at a much lower rate. So you're seeing greater concentration just through natural growth. And you see some of the GSIBs now expanding into new markets where they haven't been before. JP Morgan and Chase have announced plans to open 70 branches here in the DC area. You've got Bank of America that's moving into regional markets that they weren't. So the question is, do you want some counterbalance there, and how is that going to be an effective counterbalance? I think having a strong regional bank presence, a number and diversity of regional banks that have both the scale to compete with those largest and most complex institutions in terms of deposit gathering, technology, consumer-facing platforms, and cybersecurity, I think is a good thing. I think, I don't think we're going to see mergers that would form a new GSIB. I don't think the regulators, even this set of regulators, would be open to that kind of combination.
Yeah, I think an important element of the question really deals with the technological changes that are occurring in financial intermediation. And I've heard, and I assume that it is factual, that one of the reasons why large financial institutions have been successful in organic growth is because of the technology platforms they offer customers, and therefore those technology platforms are, in fact, because they have the money, these large institutions have the money to invest in them and to offer them to customers, are in fact a driving force of that organic growth. And if that is the case, then this is a trend that's just going to happen. And I think Aaron started off in his very early comments saying that we had 16,000 depository institutions. I don't recall, Aaron, if you had mentioned how many we have now, but it's under 5,000. So over the course of my career, I have, just like Aaron has said, I've witnessed, actually, I think it was more than 16,000 when I first started, institutions. But there are other countries where the number of financial institutions, at least large banks, and then you have the equivalents of credit unions or the like. I mean, the large banks are very, very few, relatively speaking. Canada basically has 5, some say 6, large financial institutions, and it appears to have managed that process fine. But consolidation is going to happen, and the question then becomes, does that consolidation actually result in, because of the other elements of regulation, does that result in higher risk of failure or a cost to the deposit insurance fund or society generally from one of those failing? And that's where all these other regulations come into play.
I think a fragmented banking system is better. On technology, it seems to me, if you look back over the last 250 years or so in banking, that the really important shifts in technology that affected banking have been collective shifts. So the check and the clearinghouse, or at the retail end, ATMs, or the chips system. One of the things that's happening so far, we're only a few years into this technological change, is that a lot of the cutting edge technology seems to be within private institutions. My prediction would be that actually this will end up being public, because these are more like public good type things than private goods. Who knows? Maybe it'd be different this time round. But I think it should be a matter of regret that some of the GSIBs on both sides of the Atlantic are now even bigger.
So I want to get to audience questions, but I have one sort of final question that I feel like comes up a lot when people talk about the large institutions that weren't GSIBs that failed during the financial crisis, people talk about how they were sort of, IndyMac was a thrift that was just mortgages, right? And now you have large regionals that are much more diversified, and that should make them stronger from a business perspective. So starting with Paul, we can just go down the line. I mean, do you buy that argument? Do you think that they're less likely to fail because they're more diversified?
Yeah, but you might need to. I mean, the classic case of diversification in the crisis is geographical diversification. It's HSBC here. Almost nobody loses more in the subprime market than household finance, which was owned by HSBC. HSBC didn't post, I think, even a single quarter's loss, and that's because of profits from elsewhere in the world. Yes, diversification is good, but a whole economy can take a downturn, and this is not a backhanded way of saying, and therefore the regionals should become international and global. I think they should do what they are good at, but they are a bit less diversified, and therefore other things being equal, need a bit more equity. They're a bit less systemic, and therefore need a bit less equity. And all of these things should be taken into account. But the idea that if you get into if you get into real estate as well as mortgages, real estate consumer lending, that means you've suddenly got diversification that can protect you from a downturn in the economy. That's not right.
Yeah, I mean, diversification is overall a plus, especially if it's true diversification and you aren't dealing with asset types or business lines that have a correlation with one another, and you're sort of eluding diversification when in fact there really isn't, and that might occur, unfortunately, with regional banks because they tend to do business in a more constrained footprint. If, for those of you who recall the crisis of the late 80s, early 90s here in the U.S., it was really a series of rolling recessions, geographic rolling recessions that started in the Texas, Oklahoma, Louisiana, the oil industry. And those institutions were the first to show a high degree of distress, and it occurred in real estate, it occurred in corporate lending, small business lending, I mean, you name it, and it's because basically the whole economy, and it's a little like what Paul is saying, he was alluding to on a national level or international level, but with a regional, it takes place at a smaller footprint. So yeah, I think that has to be balanced against once again, the capital structure, which is really important, because one reason why IndyMac had such high losses is so much of its capital structure was secured funding. And that secured funding was fully protected, which meant that the unsecured funding associated with IndyMac, which included the deposit class, had to bear a high degree of loss. And so, the capital structure is very important to that. So you can't look at diversification without thinking of the capital structure of the bank, really.
Yeah.
So I'd have to agree. I mean, I think most regional banks today are more diversified, particularly on the product line, than IndyMac and WAMU, who were really highly concentrated in residential mortgage. But I don't think people should take any serious comfort from that, in the sense that everybody always seeks to prevent the last crisis. The next one is probably not going to be residential mortgage. There's high degree of corporate leverage in the market today, so it's probably going to be a corporate-led recession. So there will be a turn in the credit cycle that will put stress on bank balance sheets. I think we're better capitalized, have better liquidity, and are more prepared for that than we were in the past. But you got to be vigilant every day.
So I think I can fit in two questions. I'll just get them back to back.
Yeah.
Oh, I'm sorry. Great. We have plenty of time for audience.
That's good. Good mistake.
So, fake out. And introduce yourself.
Hi, I'm Shakir. I'm from Johns Hopkins.
It's not switched on.
So I'm a grad student at Johns Hopkins.
No,
We can hear you.
but the people watching can't.
Hello. Hi. I'm Shakib. I'm a grad student from Johns Hopkins studying risk management. And my first and my question is, I'm trying to get a better understanding of, are we heading towards another recession in like in the coming years, or like what are the in your expert opinion, what would you say some of the indicators which are maybe pointing towards something like that happening in the near future? Thank you.
Yep. Whoever wants to take that one.
So the unconditional, long-term average probability of a recession any 12-month period is, I'm looking across to former Vice Chair Cohn, about 15%, something like that, I think. So recessions happen. They sometimes happen after credit booms, but they can happen for other reasons as well, like the trade thing. I think the most important thing at the moment is not when the next recession will come, but that monetary policy makers have a lot less ammunition to fight the next recession than Don's and my generation did, because we started off both here and in the UK and continental Europe with interest rates at around 5, so we took them down to 0 pretty quickly, which pushed real interest rates negative, and then we expanded our balance sheets. But of course, the central banks have already bought a lot. So there's this big debate going on in town over the next few days about, will people make greater use of fiscal policy? That bump, particularly in this country, that bumps into, but hold on, Congress finds it hard to reach decisions quickly, and it may reach its decision so slowly that you no longer need fiscal stimulus. And then you get into a very difficult debate about whether, well, can central banks do slightly more fiscal things, which that would be going too far away from the subject of this, but that bothers me greatly because we don't elect our central bankers. So I think the question that you're interested in, for what it's worth, in my former world, there's hardly a bigger issue and people don't have the answer.
Well, and are there any dynamics out there in the economy right now that pose particular risks to regional banks in particular?
Well, if you landed from, say, 20 years ago into today, you'd think, wow, unemployment's that low, and participation in the labor force is that high, and we've had this many years of uninterrupted growth. We're kind of due one. I don't mean that in a moral sense. We're never due a recession, but leverage going up in all sorts of markets. Asset prices are pretty high. Equities are pretty high. I don't know. Maybe this will be sustained for a while. I actually, for what it's worth, Victoria, I ended up thinking none of these early warning systems work terribly well, which is why I ended up thinking it's preparing, whether it's macroeconomic stimulus or resolution policy, it's how you respond when it happens, because you know it will. And that having a policy regime, you shouldn't have your policy regime based too much on, we'll be really good at spotting it next time, because I hope that, but I don't believe it.
Yeah, I absolutely echo Paul's comment. I have no idea when the next recession is going to hit, but there will be one at some point. And the question is, how prepared are regulators and the industry to withstand it and mitigate the effects of it? The regulatory tools, that toolbox certainly has fewer tools in it now than it did before the last crisis, so that's problematic. Are the regulators smart enough to work around it? Will there be political will to change that? Who knows? That's sort
what
of
is the answer to that question?
But I think the key issue for resolution planning purposes is, will there be enough capital at the institutions, the GSIBs, for example, the bail-inable, the TLAC, capital, such that it serves as a ready source to recapitalize the institutions, because almost by definition, a recession results in depository institutions needing recapitalization, and that either comes from the private sector or the public sector.
Yeah.
And if it comes from the private sector, is it going to be available? And that was the problem in the last recession, was that it wasn't available, because during a period of recession, capital gets to be extremely expensive, and as a result, it's generally unavailable, and as a result, it has to come from the public sector. And the question is, will it be available at the public sector, and what form will that take? And that was TARP, or a portion of TARP, and that's sort of an open issue.
So generally agree. I'll diverge a little bit from Jim's comments in the sense that while a recession is inevitable at some point, and whether that's 6 months, 12 months, 24 months, your guess is as good as mine. I wouldn't necessarily jump to the conclusion that the next recession will, require any large institution to go through the resolution process. I think capital and liquidity is much higher within the system today than it was before the crisis. The quality of capital is far superior. I think we have something that we didn't discuss here, which is really one of the main benefits, key post-crisis reforms was stress testing, which all major institutions do in the United States and in England. We stress our balance sheets now to see what would happen if we face a Great Recession. Will the next recession be a Great Recession or something like that? Hopefully not. I do worry, though, and I'll echo Paul's comments here, that even with a more shallow recession, I do worry that we're less capable to respond today. I think the economies, both in the U.S. and in the global economy, are weaker today than they were going into the last recession. I think fiscal policy, particularly in the U.S., may not be as available as it was in the Great Recession. We are already printing over $1 trillion deficits, and that's while the economy is booming and unemployment is at an all-time low. So you could see there being less flexibility on the fiscal side in the U.S. to counteract what will eventually be a recession.
Why don't we take 2 or 3?
Okay, yeah.
Thank you. Bert Ely, a banking consultant. I have a question with regard to the resolution plans that have been talked about. To what extent have the regulators tried to put together the resolution plans for, let's say, the 10 or 20 largest banking companies to see how they might interact during a downturn, to in turn try to identify situations where too many resolution plans call for the same course of action, which almost guarantees a collective failure of the resolution plans?
Yeah.
We can take another question, too. Up here in the green tie.
Thank you. Carl Gallivan. You mentioned going back 250 years. I'd just like to offer a point of contrast. 1837, and as a reference, Andrew Jackson's farewell address of that year. There's several thousand words about banking and money. He'd paid off the federal debt to 0, and the money was constitutional gold and silver coin, which there was a quantity that permanently circulated, and so there was stability. Also, constantly more money being brought into circulation through the free coinage of gold and silver. So the Federal Reserve was brought into existence in 1907 or 1913 because of the panic of 1907, promising to end this cyclical period of crises. Do we maybe need to consider going back to a constitutional monetary unit with wireless technology, of course, allowing the velocity of gold or silver to be
President Jackson,
transferred?
of course, was just 25 years
high.
before the Civil War.
We'll take one more in the brown jacket and the blue shirt.
Stuart Brown, Warren Capital. So in the last 18 months, we had one croaked bank and a runway, and I'm just wondering how many croaking aircraft are landing on that runway, and is the number increasing, or where does it stand? Banks that are not dead but perhaps running into trouble. I'm also wondering if FDIC is as robust as it was before. We've got a president who's not especially great at building up our institutions. And I'm also wondering if stuff like the choking repo market and Goldman choking on Lyft and Uber and WeWork are canaries.
All right, a lot there. Jim, you want to start?
Yeah, I don't know where to start. The regulators keep a problem bank list. I don't know how many problem banks there are right now.
Thank you.
Yeah, okay. So in the overall scheme of things, a relatively small number. And the one takeaway, though, I would want to leave you with is that that's looking in the rear view mirror. And I can't emphasize that strongly enough. I already alluded to his comments about no failures in 2005 and 2006. But the reality is all supervisory regulatory reports, when you look at something like a problem bank report, that's looking in the rearview mirror because those are examinations were done a while ago. And so you're dealing with a timing issue, and then also you're dealing with the unforeseen issue. And I think that's actually become a more material problem right now. I think we've done a great job of learning from our mistakes and that we're not going to repeat the mistakes. But it's those unforeseen issues that we really haven't thought about. A little bit like today's discussion, we focus on a GSIB resolution. We really haven't focused on this class of institutions, this cohort, and yet it very well could be a risk. And so that, I think, ultimately is really what we need to be concerned about.
So to the question about what if a number of GSIBs fail together, if one believes that the bail-in SPE thing is a really great resolution strategy, which I certainly believe it is, but I would, you want to make sure that these bail-in bonds aren't held by other banks, aren't held by money market institutions, and if they're held by insurance companies and pension funds, that they're subject to concentration limits. You wouldn't want, say, CalPERS to be owning all of the bail-in bonds issued by all the big American banks. And something that I said when I was responsible at kind of G20 level for this, and I don't think it's happened enough, is bail-in policy isn't just for bank supervisors and bank resolvers. It needs to involve, I've implied, insurance regulators, and to the extent they exist, pension fund regulators, but also securities regulators. Italy had a problem because Italian households invested a lot in bank bonds. And all of this is foreseeable and can be addressed, but hasn't so far. On the repo market point, I think part of what was going on was hoarding of reserves by some of the big banks. This is quite concerning. 2007 was harder to navigate because of hoarding of reserves by a few banks here, a few banks in London, a few banks in continental Europe. Frankly, I think that the mess doesn't reflect very well on that bit of the authorities, but they've got time to come up with a better system, and I think they can, and I think they need to. When you hit these crises, you need great resolution plans, you need a money market that works, you need effectively monetary policy system, and there's a degree of urgency about this because, going back to the earlier question, we don't know when this recession will come, only that it will.
Yeah, I think we're out of time, but I really appreciate everyone for being here. I enjoyed the discussion. Hopefully you all did as well.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.